Hi dear. Welcome to your favorite audiobook channel, Wisdom Flicks. The art of trading, these 10 principles will change your trading game. Are you tired of confusing strategies and emotional roller coasters? Ready to trade with confidence, discipline, and clarity? This book will transform the way you think about the market, revealing powerful principles that top traders use every day. From mastering your mindset and managing risk like a pro, to reading the market like a story and evolving with every trade. These lessons will help you trade smarter, not harder. Get ready to break free from frustration and step into consistent, lasting success. Your trading journey starts here. Introduction: trading is not just a skill. It's not just about reading charts, following trends, or listening to market news. At its core, trading is an art, a craft that blends psychology, discipline, patience, and decision-making into one powerful performance. Many people step into trading with big dreams. They believe it's a quick path to wealth, a shortcut to freedom, or an escape from the 9-to-5 routine. They imagine fast profits, flashy wins, and a life of comfort. But the reality is very different. Trading will test you. It will test your emotions. It will test your patience. It will challenge your discipline. It will put you face to face with fear, greed, uncertainty, and doubt. And it will demand more from you than you ever thought possible. This book was written for one purpose: to guide you through that test and help you win. Whether you're just starting your trading journey or you've been in the markets for years and still feel stuck, you'll find something here that can shift your perspective. Because the truth is, the difference between those who succeed in trading and those who fail is not intelligence. It's not luck, and it's not even experience. The difference is understanding and mastering the principles that drive consistent success. You won't find quick hacks in these chapters. You won't be promised easy riches. What you will find is a set of 10 powerful, timeless principles that can transform the way you approach the markets, and more importantly, the way you think as a trader. These principles are not just techniques. They are habits, beliefs, mental frameworks. They are the foundation that every great trader builds upon. Once you learn them, and more importantly, once you live by them, trading becomes something entirely different. It becomes simpler, clearer, more rewarding, and yes, more profitable. Each chapter in this book will break down one essential principle. We'll explore what it means, why it matters, and how you can apply it directly to your trading journey. You'll hear stories, insights, and hard-earned lessons drawn from the real world of trading. You'll learn how to avoid common traps, how to master your emotions, and how to build a mindset that thrives in chaos. Because that's what markets are: chaotic, unpredictable, sometimes unfair, but also full of opportunity. And the only way to survive and succeed in this environment is to develop an inner edge, an unshakable foundation of knowledge, confidence, and control. That's what this book will help you build. That if you're tired of emotional trades, sudden losses, and inconsistent results, if you're ready to stop gambling and start thinking like a professional, if you're ready to treat trading as a serious discipline rather than a casual hobby, then you're in the right place. Let's begin your transformation. Let's explore the 10 principles that will change your trading game. And remember, this is not just about the market. It's about you, your mindset, your actions, your evolution. This is the art of trading. Let's get started. Chapter 1. The Trader's Mindset. Think like a winner before you learn any chart pattern, before you study any technical indicator, and before you enter a single trade. You must build the right mindset. Because in trading, your mindset is your first, and often your only, real advantage. Many new traders think that success comes from having the perfect strategy. They jump from one method to another, constantly chasing the next big breakthrough. But here's the truth: strategies may change, but your mindset is what determines whether you follow your plan, manage your risk, and stay in the game long enough to win. The market doesn't reward those who know the most. It rewards those who can think clearly, act decisively, and stay calm under pressure. It rewards those who understand that trading is not about predicting the future, but about managing uncertainty. Why mindset matters more than you think. Trading is a mental game. It's a game of probabilities, patience, and emotional control. Even if you have the best trading system in the world, you will still lose money if you can't stick to it. You will panic when the trade goes against you. You will hesitate when you should act. You will revenge trade, overtrade, or break your own rules. That's why professional traders spend less time obsessing over the market and more time mastering themselves. They understand something most beginners don't. You don't trade the market. You trade your beliefs about the market. If you believe the market owes you something, you'll trade with entitlement and frustration. If you believe you need to be right all the time, you'll struggle to accept losses. If you lack confidence, you'll second-guess your decisions and miss opportunities that trade like a winner. You must think like a winner. Principle 1. Let go of the need to be right. This is one of the most important mental shifts you'll ever make as a trader. Most people are conditioned to seek validation. We're taught that being right is good and being wrong is bad. But in trading, this mindset can be destructive. Here's why. No matter how skilled you are, you will be wrong. A lot. Even the best traders in the world lose on 40 to 50% of their trades. The difference is they don't take it personally. They don't attach their identity to a single outcome. They understand that losses are simply part of the process. When you let go of the need to be right, you free yourself from the emotional weight of every trade. You begin to see trading for what it really is, a series of probabilities. A long game. A business. Your job is not to win every time. Your job is to follow your edge consistently and manage your risk wisely. That's how you become profitable, not by being right, but by being disciplined. Principle 2. Confidence comes from clarity. Confidence is essential in trading. Without it, you'll hesitate, doubt, and second-guess every move. But true confidence doesn't come from wins. It comes from clarity. When you know exactly what your trading plan is, your entry rules, exit rules, risk parameters, and trade management approach, you no longer rely on emotion. You don't need to feel confident. You are confident because you're prepared. Clarity turns chaos into structure. It helps you filter out the noise. It allows you to act with certainty even in uncertain conditions. Confidence built on clarity is calm, stable, and powerful. Confidence built on emotion is fragile, short-lived, and dangerous. The more clarity you create around your trading process, the more consistent your results will become. Principle 3. Accept uncertainty as part of the game. One of the hardest things for new traders to accept is that the future is unknowable. No setup is guaranteed. No trade is ever a sure thing. The market is a living, breathing organism. It can change direction without warning. It can move in ways that make no logical sense. It does not care about your plan, your opinion, or your feelings. The only way to thrive in this environment is to embrace uncertainty. You do this by shifting your focus away from predicting and toward preparing. You prepare for different outcomes. You define your risk in advance. You know what you'll do if the trade works, and what you'll do if it doesn't. This mindset gives you freedom. You stop chasing perfection. You stop needing to know what's going to happen. You simply focus on making the best decision with the information you have right now. And that is what makes you powerful. Principle 4. You are your greatest asset. There's one element in your trading that is always present. You. Your strategy may change. Your tools may evolve. The market may shift. But you are the constant. That's why your greatest investment will always be in yourself. Your emotional intelligence, your patience, your discipline, your ability to stay focused and stick to your plan. Winners don't just know the markets. They know themselves. They study their behavior. They track their performance. They reflect on their mistakes and work on their mindset daily. But if you want to trade like a professional, start thinking of yourself as an athlete. Prepare your mind like a fighter. Sharpen your discipline like a soldier. Because when it comes to trading, your mindset is your weapon. Final thoughts. Mindset first. Always, you don't need to master everything at once. But if there's one area you should focus on first, it's your mindset. Because once your mind is steady, the rest of your trading becomes easier. Your losses become learning opportunities. Your wins don't make you reckless. You stop forcing trades. You become consistent. The journey to becoming a successful trader begins in the space between your ears. Think like a winner, and your trading will start to reflect that. This is the foundation. This is where it all begins. Now that your mind is ready, let's explore the second principle, the power of discipline, and why rules are the key to long-term success. Chapter 2. Discipline over drama. Why rules matter. Discipline. The word itself might not sound exciting, but in the world of trading, it's everything. It's what separates long-term winners from short-lived gamblers. It's what holds your system together when the market throws you curveballs. And it's what allows you to trade with clarity when emotions try to pull you into chaos. If mindset is the foundation of trading success, then discipline is the frame that holds the structure together. Without it, your strategy, no matter how good, will collapse under pressure. And here's the uncomfortable truth. Most people don't fail in trading because of bad strategies. They fail because they break their own rules. They overtrade when they said they wouldn't. They risk more than they planned. They chase a loss, hoping to get it back. They let a small loss turn into a disaster because they just knew it would. Reverse. And when that happens, it's not the market's fault. It's a discipline problem. Why trading without rules is a recipe for disaster. Imagine flying in a plane with no flight plan. The pilot takes off, but has no destination. No idea how much fuel is needed. No plan for bad weather. That flight is not likely to end well. Now imagine you're a trader entering a volatile market with no plan. No entry criteria. No risk limits. No exit strategy. You're not trading. You're gambling. Discipline brings order to uncertainty. It creates structure in a chaotic environment. And most importantly, it removes emotion from your decisions. Without rules, every trade becomes a guess. Every market movement becomes a trigger for panic or excitement. You react rather than respond. And over time, that costs you everything. Principle 1. Your rules are your business plan. A professional trader treats trading like a business. And every successful business runs on systems. Your trading plan is your business manual. It outlines exactly how you will enter and exit trades, how much you're willing to risk, what setups you will take, and under what conditions. Think of it this way. If your money was being managed by someone else, would you let them trade based on hunches and feelings? Or would you expect them to follow a precise, written plan? Your trading account deserves the same level of care and structure. If you don't follow your own rules, why should the market reward you? Principle 2. Discipline is hard in the moment, easy in the long run. In the short term, discipline can feel boring. It means saying no to impulsive trades. It means waiting for confirmation. It means watching others jump into moves while you stay patient. And yes, it means missing some trades that end up working. But in the long run, discipline is what makes trading easier. Because with discipline, you stop fighting yourself. You stop second-guessing every move. You stop repeating the same mistakes. You begin to trust your process. You build consistency. You feel less stress. And you create a track record that actually means something. Without discipline, every trade is a new emotional roller coaster. You win, you get greedy. You lose, you get reckless. The cycle never ends. But with discipline, you break that cycle. You create stability in your actions, even if the market remains unpredictable. Principle 3. Discipline protects you from yourself. Let's be honest. Your biggest threat as a trader is not the market. It's you. It's your fear when a trade goes red. It's your greed when a trade goes green. It's your need to be right. It's your urge to jump in without thinking. Discipline is the wall that keeps those emotions from hijacking your trades. It's what stops you from taking 5 trades when you plan to take 1. It's what reminds you to walk away after a losing streak. It's what keeps your risk per trade consistent. Even when you feel sure this one will work, you don't need to eliminate emotion. You just need to make sure emotion doesn't drive your decisions. That's what discipline does. Principle 4. Rules remove regret. One of the worst feelings in trading is not losing. It's regret. It's the voice that says, I knew I shouldn't have taken that trade, or I broke my rule again. Regret doesn't come from loss. It comes from knowing you didn't follow your own process. But when you trade with discipline, win or lose, you sleep better at night. Because you know you did your job. You followed your plan. You acted with integrity. And over time, that mindset leads to not only better trades, but better confidence. You stop beating yourself up. You stop needing to win every time. You stop measuring your success by single trades. Instead, you start seeing the bigger picture. You become a strategist, a professional, a disciplined executor. Principle 5. Your edge only works if you do. Every trader is told to find their edge. That's great advice. But here's the catch. An edge is only useful if you actually apply it. An edge without discipline is like a map you refuse to follow. It's useless. You might know exactly what works for you, your favorite setup, your preferred risk level, your best time to trade. But if you don't stick to that formula, you sabotage your own success. Discipline is the glue that holds your edge in place. Without it, even the best system will fail. With it, even a simple strategy can outperform the market. So the question isn't, do you have a good strategy? It's, do you have the discipline to follow it? Building your discipline muscle discipline is not something you're born with. It's something you build. Like going to the gym, it starts small. One decision at a time, one trade at a time, one day at a time. And the more you practice it, the stronger it gets. Start by creating non-negotiable rules. Never risk more than a set percentage per trade. Always wait for confirmation before entry. Walk away after your max daily loss. Review your trades every week, win or lose. These simple rules can change everything. Because when you follow them, you create habits. And habits create consistency. Discipline is a daily choice. It's not always easy, but it's always worth it. Final thoughts. Choose discipline, not drama. The market is full of noise. Breaking news, social media, expert opinions, wild price swings, they all invite drama. They all beg you to react, to chase, to panic. But you have a choice. You can choose discipline over drama. You can choose structure over chaos. You can choose to be a trader, not a gambler. And every time you make that choice, you become stronger. You build trust with yourself. You become more consistent, more resilient, more professional. Discipline is not what limits your trading. It's what frees you to perform at your best. As you continue this journey, remember, your edge is not your setup or your indicator or your entry signal. Your edge is your ability to follow your plan when it matters most. Master discipline, and you master the game. Now let's turn to Chapter 3, where we tackle one of the most critical parts of professional trading, risk management. Because no trader lasts long without it. Chapter 3, Risk Like a Pro, Mastering Money Management. If there's one principle that every successful trader lives by, it's this: protect your capital at all costs. While mindset and discipline shape how you trade, money management determines if you'll last. You can have the best strategy in the world, but if you don't know how to manage risk, you're walking on a tightrope without a safety net. Amateurs obsess over how much they can make. Professionals focus on how much they can lose and still stay in the game. Because in trading, survival is success. Why most traders blow up? The statistics are brutal. Over 80% of traders quit within their first 2 years. Not because they didn't have talent, not because they didn't try, but because they didn't respect risk. They over-leveraged. They went all in on a sure thing. They doubled down. After a loss, they ignored stop losses. They mistook hope for a strategy, and the result? A blown account, a shattered confidence, a dream cut short. Let's be clear, you don't have to win every trade to be a successful trader, but you do need to manage your losses. Because how much you lose matters more than how much you win. In this chapter, you'll learn how to think like a risk manager first and a trader second. Principle 1. Never risk more than you can afford to lose. This might sound obvious, but it's the first rule most traders break. Ask yourself, how much can I lose on a single trade without feeling emotional, without breaking my plan, without trying to make it all back immediately? That number is your maximum risk per trade. And for most professional traders, it's somewhere between 1% to 2% of their total account balance. If you're trading a $10,000 account, risking 1% means you're risking $100 per trade. That's your damage limit. It's the cost of doing business. This does not mean you trade scared. It means you trade smart. You give your trades room to work, but you never allow a single trade to destroy your account or your confidence. Principle 2. Define risk before you enter, not after. Every trade must start with a clear question. Where will I exit if I'm wrong? This is your stop-loss level. It should be decided before you click the buy or sell button, not during the heat of the moment. Why? Because emotions cloud judgment. Once money is on the line, your brain wants to avoid pain. It wants to delay the loss. It wants to believe maybe it'll come back. But hope is not a plan. By defining your stop-loss in advance, you remove emotion from the equation. You trade with clarity. You protect your capital. And most importantly, you preserve your decision-making ability for the next opportunity. Professional traders don't just ask, how much can I make? They always ask, what am I risking to get it? Principle 3. The risk-to-reward ratio is your lifeline. A winning mindset alone is not enough. You need math on your side. Every trade should have a favorable risk-to-reward ratio. This means the potential reward should outweigh the risk, ideally by at least 2 to 1. If you risk $100, you should be aiming to make $200 or more. Why does this matter? Because even if you win only 40% of your trades, with a 2 to 1 reward-to-risk ratio, you can still be profitable over time. Here's the equation professionals live by. Win rate x average win, loss rate x average loss. It's not about being right all the time. It's about making sure your wins outpace your losses. With proper risk to reward, you don't need to be perfect. You just need to be consistent. Principle 4. Risk management builds confidence. Most traders think confidence comes from winning trades. It doesn't. It comes from knowing you're safe. Even when you lose, when you control your risk, every trade becomes manageable. You stop fearing loss. You stop chasing revenge trades. You start thinking logically. You become more stable, more grounded, more professional. There's a deep power in knowing this trade won't make me rich, and it won't ruin me either. That's the mindset of someone who lasts in this game. Principle 5. Use position sizing to stay in control position. Sizing is the quiet engine of risk management. It answers the question, how big should this trade be? It's not about how confident you feel. It's not about how much you like the setup. It's about math. Here's a simple method. Determine your account size. Choose a risk percentage, for example, 1%. Define your stop loss in pips, points, or dollars. Calculate the position size that keeps your risk within that 1%. Let's say you have a $5,000 account. You risk 1%, $50. Your stop loss on a trade is 50 cents per share. To risk only $50, you can buy 100 shares. That's your position size. With this approach, you stay consistent. You don't overbet on winners. You don't shrink from losses. You stay steady. And in trading, consistency beats intensity. Principle 6. Never average down. One of the most dangerous habits in trading is adding to a losing position. It feels tempting. The trade is going against you, and you think, if I add more now, I'll reduce my average price. It'll bounce back, and I'll make even more. But what if it doesn't? Suddenly, your small loss becomes a large one. Your risk explodes. Your emotions take over. You start hoping instead of thinking. Professional traders don't average down. They accept the loss. They protect their capital. They move on. Remember, you can always re-enter later, but you can't recover from a blown account. Principle 7. Your goal is to stay in the game. Risk management isn't just about individual trades. It's about survival. Your real goal in trading is to last, to stay in the game long enough for your edge to play out, for your experience to grow, and for your capital to compound. That's why top traders think in terms of series of trades, not single trades. They understand that any one trade is irrelevant in the big picture. What matters is protecting their account, managing their downside, and giving themselves time to win. You don't need to hit home runs. You just need to avoid striking out. Final thoughts. Respect risk, and it will respect you. The market does not owe you anything. It doesn't care how smart you are, how much research you did, or how confident you feel, but it will always reward those who manage risk with precision, discipline, and humility. When you learn to think like a risk manager, you stop trading to get rich quick. You trade to build something that lasts. You trade like a professional. Ask yourself before every trade, what am I risking? Why am I risking it? And is it worth it? If you can answer those questions with clarity and confidence, you're already ahead of most. In the next chapter, we'll explore the principle that ties everything together, patience. Because in trading, the ability to wait for the right moment often separates a good trade from a great one. Chapter 4. Patience is power. Waiting for the right setup. Patience. It's not flashy. It doesn't make headlines. It doesn't give you a rush of adrenaline. But in trading, patience is your silent superpower. In a world of instant gratification, where everything moves fast, where everyone is chasing the next big move, and where alerts, signals, and breaking news fill your screen, the ability to wait is becoming rare, and yet, it's precisely what separates the impulsive trader from the consistently profitable one. Because trading is not about activity. It's about precision. It's not about being busy. It's about being ready. It's not about how often you trade. It's about how well you trade. And to trade well, you need to wait for your moment. Why patience matters more than you think. Most traders lose money not because they don't know what to do, but because they act too soon. They enter before their setup is complete. They force trades out of boredom. They chase moves they've already missed. They act not from conviction, but from impatience. But here's the reality. The market doesn't reward speed. It rewards timing. Every strategy has moments when the odds are in your favor and moments when they're not. The edge is only present at very specific times. Your job as a trader is to wait for those moments, then act with precision and confidence. Professional traders are like snipers. They don't fire at every movement. They wait. They observe. They prepare. And when the target is perfect, they strike. Principle 1. Boredom is the enemy of patience. Boredom is a dangerous emotion in trading. When you're bored, you look for excitement. And the market offers it, plenty of it. There's always something moving, something breaking out, something trending. The temptation is constant. But just because something is moving doesn't mean it's the right opportunity. When boredom enters your trading room, it whispers things like, "You haven't taken a trade all day. Just jump in. You missed that move. Don't miss the next one. You need to make something happen." And that's when discipline collapses. That's when you take trades that don't fit your plan. That's when losses pile up. Not because the market was tough, but because you couldn't wait. Patience is the antidote to boredom. It allows you to stay grounded, to remember that trading is a game of selectivity, not speed. Principle 2. The market is not going anywhere. Here's a truth that will help you stay patient. The market will always give you another opportunity. Maybe not today, maybe not this hour, but soon enough, your setup will appear. The pattern will repeat. The conditions will align. Your moment will come, but only if you're willing to wait for it. Impatience tells you this is your last chance. That if you miss this trade, you've missed everything. But seasoned traders know that there are always more trades. The market is like the ocean, waves keep coming. You don't need to chase one that's already breaking. Just wait for the next one. Be ready. Be prepared. But don't be desperate. Opportunity favors the patient. Principle 3. Great trades are clear, not confusing. One of the biggest lessons in trading is this. If the setup doesn't feel obvious, it's probably not worth taking. When a high-quality trade presents itself, it doesn't scream. But it does feel clear. Clean levels, strong structure, alignment with your strategy. Everything just makes sense. On the other hand, when you're impatient, everything starts to look like a setup. You begin to interpret noise as signals. You force the chart to match your expectations. You convince yourself that a mediocre trade is good enough. That's when mistakes happen. Truly great trades don't require convincing. They speak for themselves. You don't have to force them. You simply recognize them, prepare your entry, manage your risk, and execute. The best trades are the ones that require the least hesitation. And those are the ones worth waiting for. Principle 4. Patience protects you from overtrading. Overtrading is one of the most common and costly habits among new traders. That it's driven by emotion, fear of missing out, the urge to recover losses, the excitement of being in the market. But underneath all that is one problem: a lack of patience. Every trade carries risk. Every entry is a decision that requires capital, attention, and discipline. When you trade too often, you dilute your focus. You become reactive instead of strategic. And soon, your account reflects the cost of impatience. But when you're patient, you become selective. You learn to say no to setups that don't meet your criteria. You conserve your capital and your mental energy. You stay in control. Fewer trades, better trades, stronger results. Principle 5. Waiting is also a trading skill. Waiting isn't just something you do between trades. It's a skill. It's an intentional practice. And like any skill, it gets stronger with repetition. Waiting teaches you discipline. It trains your brain to focus on quality. It conditions your emotions to stay steady under pressure. You begin to develop an internal compass, a sense of timing, rhythm, and structure. You stop reacting to noise and start responding to signals. You become more in tune with your strategy, more connected to the market, and when your setup finally appears, you're not scrambling to respond. You're calm, focused, ready. That's what separates a rush trader from a confident one. Principle 6. Patience doesn't mean inaction. Being patient doesn't mean being passive. While you wait for your setup, you're not just sitting idle. You're observing. You're preparing. You're planning. You're analyzing potential levels. You're checking the context. You're aligning your strategy. Patience is active preparation. It means you're mentally engaged, but emotionally detached. You're alert, but not anxious. You're ready, but not rushing. When the right trade comes, you're not reacting. You're executing a plan that's already in place. That's the true power of patience. It turns waiting time into preparation time. Final thoughts. The reward of patience: the market has a rhythm, a flow, a natural pace. And when you slow down and sync with it, you stop fighting it. You stop rushing. You stop chasing. You stop forcing trades that don't belong. Instead, you wait. You observe. You strike when it's time, and only then. Patience will not only protect your account, it will strengthen your discipline. It will sharpen your edge, and it will give you a quiet confidence that separates real traders from the rest. Because in trading, the money isn't made by being in the market all the time. It's made by being in the market at the right time. Wait for it. Respect the process. And trust your preparation. In the next chapter, we'll talk about keeping your strategy simple, because complexity might look impressive, but simplicity is what actually works in the real world. Chapter 5. Keep it simple. The power of a clean strategy in trading. Complexity often masquerades as intelligence. Many new traders believe that the more complicated their strategy, the better their chances of success. They pile on indicators, tweak dozens of variables, and spend hours looking for the perfect setup. But here's the truth most seasoned traders will tell you: simplicity wins. The market rewards clarity, not clutter. A clean strategy is not only easier to follow, it's more consistent, more adaptable, and less prone to emotional sabotage. Let's break down why keeping it simple can change your trading game forever. Point 1. The illusion of complexity. Imagine a trader who uses 5 indicators: MACD, RSI, Bollinger Bands, Fibonacci levels, and moving averages, all layered on one chart. Every signal contradicts another. When the RSI says buy, the MACD says sell, and the trader freezes, confused. This kind of paralysis is common when your screen becomes a battlefield of opinions. Complex strategies create decision fatigue. The more choices you have, the harder it becomes to make a confident move. And in trading, confidence is everything. A clean strategy eliminates that chaos and gives you a roadmap you can trust. Point 2. Why simplicity works. Markets are driven by crowd psychology, fear and greed, buying and selling. At their core, price movements follow simple laws of supply and demand. The most successful strategies align with those principles: support and resistance, trend following, and momentum. A clean strategy strips away the noise and focuses on what really matters. It's repeatable, testable, and teachable. More importantly, it gives your brain the space to focus on execution, not overanalysis. Point 3. The foundation of a clean strategy. So, what does a clean trading strategy actually look like? 1 or 2 indicators, max. Maybe a moving average and a momentum indicator. That's enough. Clear entry and exit rules. You don't hesitate because your rules are specific. Defined risk parameters. You know how much you'll risk before every trade. Simple chart setup, no clutter. Just price action, volume, and your chosen tools. Here's an example. I only trade in the direction of the 50-day moving average. I enter when the RSI pulls back to 40 in an uptrend. Stop loss is 1% below the last swing low. Take profit at a 2-to-1 reward to risk ratio. That's it. Simple and powerful. Point 4. Clarity builds confidence. When your strategy is simple, you execute without hesitation. You don't second-guess the signal or try to reinterpret it. That kind of clarity builds consistency. And consistency builds confidence that you're no longer reacting emotionally. You're following a proven process, even when a trade goes wrong. And some trades will. You don't panic. You know the setup. You followed the plan. That's a win, regardless of the outcome. Point 5. Adaptability in changing markets. Complex systems tend to break when markets shift. But a simple strategy can be adjusted quickly. Maybe the market is trending, maybe it's ranging. Either way, you can recognize the condition and adapt your clean system accordingly. Also, simple strategies are easier to backtest and improve. You don't need a PhD in quantitative analysis to know if your setup works over time. You just test it, review it, and refine it. Point 6. The emotional edge. Simplicity gives you an emotional edge. It removes the anxiety that comes from too many variables. You trust the process. You don't need to guess. And when your emotions are calm, your execution improves dramatically. Think of your mind like a computer. Every added indicator, every rule, every what if uses up processing power. Eventually, your system crashes, not because it was wrong, but because it was overloaded. The best traders don't think more. They think better. And thinking better begins with simplifying. Point 7. Real traders, real simplicity. Some of the world's most successful traders use the simplest strategies. Paul Tudor Jones once said, "The most important rule of trading is to play great defense, not great offense." Jesse Livermore, one of the greatest traders in history, made millions by identifying trends and riding them. Mark Douglas, author of Trading in the Zone, emphasized the importance of mindset and following a straightforward process without emotion. These traders weren't chasing complexity. They were mastering simplicity. Point 8. Build your own clean strategy. Here's how to create a simple, effective strategy. Choose your market: Forex, stocks, crypto, futures. Focus on one. Pick one directional tool: a moving average, price action, or trend line. Pick one entry trigger: a pullback, breakout, or pattern. Set your risk rule: fixed stop loss and reward to risk ratio. Define your time frame: 1 hour, 4 hour, daily. Pick what fits your lifestyle. Test it, backtest it on past data. Review the results. Make small tweaks. Commit. Follow the strategy for 30 trades. Don't change midway. Observe the outcomes. Final thoughts. Simplicity scales. The more you simplify, the more space you create for growth. A clean strategy is not a beginner's trick. It's a professional's weapon. It allows you to focus, adapt, and win without the emotional drain of overanalysis. Remember, your goal as a trader isn't to be clever. It's to be consistent. And consistency lives in simplicity. Simplicity is power. Simplicity is mastery. And in trading, mastery is what separates the winners from the watchers. Let go of the noise. Trust the process. Keep it simple. Chapter 6. Losses are lessons. Learning to let go in trading. As in life, losses are inevitable. But how you respond to them defines your path forward. Some traders crumble under the weight of a loss. Others rise stronger and wiser. What separates them isn't skill, it's mindset. This chapter will help you reframe losses as lessons, showing you how to learn, adapt, and grow without allowing one bad trade to shape your future. The emotional trap of losses. The first thing to understand is that losses are not failures. They are part of the game. Even the most successful traders in the world, those with years of experience and millions under management, take losses. But where new traders panic or spiral emotionally, professionals stay grounded. They don't dwell. They don't chase revenge trades. They don't lose focus. Why? Because they understand that trading isn't about being right every time. It's about managing risk, preserving capital, and executing with discipline. The biggest trap after a loss is emotional trading. Anger, frustration, fear, or the desire to make it back can lead to impulsive decisions. You start breaking your rules, ignoring your plan, and suddenly one loss turns into a losing streak. The key is learning to emotionally detach from each trade. Loss is data, not defeat. Every losing trade carries valuable information. It's not just a financial result, it's feedback. Was the entry mistimed? Did you trade against the trend? Were you following your system or reacting emotionally? Losses are like a mirror, reflecting your weaknesses, blind spots, and habits. Smart traders analyze their losses with curiosity, not shame. They treat every losing trade like a teacher. What went wrong? Was it a bad trade or just a good trade that didn't work out? What can I do better next time? This reflective practice turns painful experiences into powerful insights. It's how traders sharpen their strategy and elevate their performance over time. The ego problem. Many traders struggle with losses because of their ego. They tie their identity to their performance. Winning makes them feel like a genius. Losing makes them feel like a failure. This mindset is dangerous. Your worth is not defined by a green or red number on your screen. Trading is a probabilistic game. Even the best setups fail sometimes. If you're doing everything right, following your plan, managing your risk, staying disciplined, you've already won, regardless of the outcome. Let go of needing to be right. Focus on being consistent. Cut losses quickly. One of the most important rules in trading Never let a small loss turn into a large one. Beginners often hold on to losing trades, hoping they'll turn around. But hope is not a strategy. The market doesn't care about your wishes. A small, controlled loss is a cost of doing business. A large, unmanaged loss can ruin your account. Professional traders use stop losses not because they're afraid, but because they're disciplined. They'd rather lose a little and live to trade another day. Remember, every dollar you lose unnecessarily is one less dollar you have to win with later. Move on without emotional baggage after a tough trade. Give yourself space to recover. Walk away, reflect, breathe, but don't carry that loss into your next trade. You're not trying to get even. You're trying to trade well. Each trade is a new opportunity. If your mind is still stuck in the past, you'll miss the present. Letting go also means forgiving yourself. Maybe you made a mistake. Maybe you broke your rules. That's okay. Learn from it. But don't keep punishing yourself. Every trader has battle scars. The great ones wear theirs with wisdom, not regret. Develop a journal habit. One of the best tools for turning losses into lessons is a trading journal. After every session, record what you traded, why you entered and exited, how you felt before, during, and after, what went right or wrong, what you learned over time. This habit becomes gold. You'll start spotting patterns, both good and bad. You'll see where your strategy works and where your discipline slips. Your journal becomes your coach. It helps you grow with clarity and purpose. Build resilience over time. The more you face losses with the right attitude, the stronger you become. Resilience is not avoiding pain. It's learning to rise after it. Trading will test you. It will humble you. But it can also shape you into someone patient, focused, and mentally tough. Every great trader you admire has faced brutal losses. What made them succeed wasn't perfection. It was persistence. Summary: losses are inevitable, but they are not the end. Don't take them personally. Analyze them with a cool head. Keep your ego out of the way and protect your capital. With smart stops, use a trading journal to grow and improve after every mistake. And most importantly, don't let one loss define you. Let it refine you. Losses are not the opposite of success. They are part of the path. Embrace them, learn from them, and keep moving forward. Because in trading, as in life, every setback holds a seed of comeback. Chapter 7. Consistency over intensity. Daily habits that win. In the world of trading, we often glorify intensity. We admire traders who pull all-nighters watching charts, who pore over indicators until their eyes blur, and who take big, bold positions hoping for massive returns. But if we look closely at the traders who last, the ones who succeed year after year, it's not intensity that defines them. It's consistency. The myth of hustle culture. The financial markets don't reward those who burn out quickly. Trading is not a sprint. It's a marathon. And while energy and passion are essential, they are not sustainable unless they're paired with discipline and routine. Many beginners believe that trading success comes from making a few huge plays or having a burst of luck. But real trading is built on systems, routines, daily habits. It's the quiet, repeated actions, executed with care and commitment, that compound over time. The power of small, repeated actions. Think of trading like going to the gym. One intense workout won't change your body, but working out consistently, even if only for 30 minutes a day, will transform your health over time. Trading is the same. You don't need to catch every move. You need to show up every day. You need to analyze your trades, review your strategy, keep a journal, set your alerts, check your risk parameters. These small actions don't make headlines, but they create results. Habit number 1. The daily review. Every professional trader has a review process. At the end of the trading day, take 15 to 30 minutes to assess your performance. What went right? What could have gone better? Did you follow your plan? This habit builds self-awareness. It helps you identify emotional triggers, bad habits, and moments of brilliance. Over time, you begin to refine your edge, not just in the market, but in your mind. Habit number 2. Pre-market preparation. Consistency begins before the market opens. Each day, successful traders run through their pre-market checklist. They scan the news, review economic calendars, check for earnings reports, and look at technical levels of interest. This ritual sets the tone. It tells your brain, we're here to work. It also protects you from reacting impulsively to surprises. When you know what's likely to happen, you can position yourself accordingly. Habit number 3. Focus on process, not outcome. One of the most common traps for traders is becoming obsessed with results. While profit is the goal, it shouldn't be the focus. Daily habits shift your attention from outcome to process. Ask yourself, did I follow my plan today? Did I stick to my stop loss? Did I avoid revenge trading? These questions matter more than whether you ended the day green or red. Over time, your job isn't to be perfect, it's to be consistent. When you focus on the process, the profits follow. Habit number 4. Limit screen time. Believe it or not, too much screen time can hurt your performance. Constantly watching charts can lead to overtrading, anxiety, and burnout. Top traders have screen discipline. They set boundaries. They step away when there's nothing to do. They allow the trade to come to them. It's better to take one high-quality trade a week than to force 10 bad ones daily. Habit number 5. Journal like a scientist. Your trading journal is your mirror. It's where you see your growth, your struggles, and your patterns. But journaling isn't just about writing what happened. It's about thinking critically. Write down the why behind each trade. What was the setup? What were the emotions? What did you learn? This habit deepens your awareness and builds a personal database of wisdom. Habit number 6. Embrace boredom. Great trading is often boring. It's about waiting, planning, and executing the same types of trades repeatedly. If you feel bored, you're probably doing it right. Don't chase excitement. Don't let FOMO, fear of missing out, drive your decisions. Master traders become comfortable with the quiet, uneventful parts of trading. That's where discipline lives. Why intensity fails without consistency? You might be thinking, but what if I trade intensely and consistently? That's a fair question. Intensity can be a boost, but without rhythm and structure, it leads to burnout. You don't want to flame out after one good month. You want to be in this game for years. A professional treats trading like a business. They don't rely on adrenaline. They rely on systems. They build routines that support peak performance. Even on days when motivation is low, build your trading routine. Start with a basic daily structure. Morning prep, 30 minutes news scan, technical levels, watch list setup. Live trading window. Stick to your strategy, no impulsive trades. Midday check-in. Step away or reassess market conditions. Evening review. 15 to 30 minutes journal. Review trades. Plan for tomorrow. Make this routine sacred. Let it become second nature. Over time, you'll develop a rhythm that sustains you through wins, losses, and everything in between. Final thoughts. Trading isn't about being the fastest or the smartest. It's about showing up every day with discipline, focus, and a willingness to improve. You don't need explosive energy. You need sustainable effort. Success doesn't come from what you do occasionally. It comes from what you do consistently. In trading, as in life, small wins done daily become big victories over time. Chapter 8. The Emotional Trader. Conquer your inner chaos. In the world of trading, your greatest enemy is rarely the market. It's not a volatile chart, a sudden news release, or an unexpected market reversal. It's you, more specifically, your emotions. Every successful trader eventually learns this truth. Mastering your emotions is just as important as mastering any chart pattern or strategy. Without emotional control, even the best trading plans fall apart. Let's explore how you can conquer your inner chaos and rise above the emotional storms that shake so many traders out of the game. Why emotions and trading don't mix. Trading is a business built on uncertainty. You place a trade based on probabilities, not guarantees. That uncertainty naturally stirs up emotions, especially fear, greed, frustration, and hope. Fear makes you exit too early, missing out on big moves. Greed makes you stay in too long, hoping for more, until profits vanish. Frustration causes revenge trading, jumping back in just to recover a loss. Hope makes you hold a losing trade, praying it will turn around. Each of these emotions can sabotage your decision-making. Your job is to stay emotionally neutral, even when everything inside you wants to panic or push harder. You are not your emotions. One of the most powerful ideas you can adopt as a trader is this: you are not your thoughts, and you are not your emotions. Emotions will come, thoughts will race, but they don't have to control you. Think of your emotions like weather. A storm might pass through, but the sky is still there behind it, calm, clear, and steady. Your job is to stay grounded, no matter what emotional weather blows in. Create an emotional awareness system. Before you can control your emotions, you must first be aware of them. Most traders fall into emotional traps because they don't recognize the signs until it's too late. Here are practical ways to build emotional awareness. Journal after every trade. Write down how you felt before, during, and after the trade. Were you nervous? Excited? Impatient? Score your mental state. Rate your emotions on a scale of 1 to 10. Over time, you'll see patterns. Maybe you make poor decisions when your stress level is above a 7. Use a trigger word when you feel emotion taking over. Say a trigger word like reset or pause to interrupt the cycle. By naming your emotions, you separate from them. You go from being inside the storm to watching the storm. Build emotional discipline like a muscle. Emotional control doesn't happen overnight. Like a muscle, it gets stronger the more you train it. You need to put yourself in situations where you feel pressure and practice staying calm. Ways to train emotional discipline. Trade a demo account when you're stressed. Learn to manage pressure without real money on the line. Set cool-off rules. If you lose 2 trades in a row, step away for 15 minutes before making another decision. Breathe before you act. When you feel your heart rate rise, pause and take 3 deep breaths before entering a trade. Over time, these small habits build incredible strength. You'll begin to notice that while other traders are reacting impulsively, you're staying focused. Detach emotionally from outcomes. The moment you become emotionally attached to a trade's outcome, you're no longer trading objectively. You're gambling. You're wishing. You're reacting. Here's a simple truth. You cannot control the market. You can only control your actions. You must treat each trade as just one in a long series. Whether it wins or loses doesn't matter. What matters is that you followed your process. This is the mindset of professionals. They don't celebrate a single win or mourn a single loss. They focus on consistency, accuracy, and following their edge. Develop a pre-trade routine. One powerful way to reduce emotional chaos is to create a pre-trade routine that grounds you. A strong routine removes impulsiveness and reinforces discipline. Here's what a good routine might look like. Check your emotional state. Are you calm, clear, and focused? Review your trading plan. Are you acting based on signals or feelings? Visualize the trade. See it working and not working. Are you prepared to accept either result? Set your stop loss and target. Lock in your risk. Accept it before you enter. Affirm your mindset. Say something like, I am a professional. I follow my edge without emotion. When you do this consistently, it conditions your brain to stay calm and sharp under pressure. Mindset anchors to stay centered. Here are some key beliefs you can repeat to anchor yourself during turbulent moments. A single trade does not define me. My edge plays out over many trades, not just one. I do not chase. I wait. Process over outcome. Discipline over drama. I can feel emotions, but I don't act on them. Repeat these daily. Over time, they will rewire your reactions and create a new emotional baseline. One built on stability, not chaos. Make peace with the market at its core. Emotional chaos often comes from a need to control the market. But the market cannot be controlled. It is unpredictable, ruthless, and indifferent to your plans. Let go. Accept that losses will happen. Accept that surprises will come. Accept that your only real power is in how you respond. When you stop trying to control the market, you start controlling yourself. And that's when everything changes. Final thought. Inner peace, outer mastery in trading. Emotional mastery is the hidden edge. It's the silent strength behind every disciplined execution, every patient setup, every graceful exit. You don't have to be a robot. You just need to be in control. Because when your inner world is calm, your outer performance shines. In the next chapter, we'll dive into how reviewing and refining your strategy without emotion is the final step to long-term success. Stay calm. Stay sharp. You're becoming a pro. Chapter 9. Know the game. Read the market like a story. To succeed in trading, you must first understand that the market is more than just numbers and charts. It's a living narrative shaped by countless participants, each with their own emotions, goals, and actions. Think of the market as a story unfolding in real time, full of characters, conflicts, and turning points. Learning to read this story is a critical skill that separates good traders from great ones. In this chapter, we'll explore how to approach the market as a story, how to interpret its signals, and how to anticipate what might come next. Markets are human stories in motion at its core. The market is a reflection of human behavior. Prices rise and fall not because of random chance, but because people buy and sell based on their hopes, fears, information, and reactions. Every candlestick, every volume spike, every price level tells a piece of that story. If you learn to read these clues, you gain insight into the collective psychology driving the market. This perspective helps you move beyond blind technical analysis or guesswork. Instead, you develop an intuitive understanding of why the market moves, making your decisions smarter and more confident. Chapter sections. 1. Characters in the market story. The market's characters include a variety of participants. Retail traders, individuals trading for personal gain, often driven by emotion. Institutional traders, large banks, hedge funds, and investment firms whose moves create significant market impact. Market makers, entities providing liquidity, smoothing price action. News and events, external forces that create plot twists. And surprises. Each of these groups acts with different motivations, time horizons, and resources. Understanding who's in the market at any moment helps you interpret price action more clearly. Point 2. The plot, trends, ranges, and breakouts. Just like any story has a plot, the market has phases. Trending markets. The market story is clear. Prices move steadily up or down, driven by conviction. Ranging markets. The market story is uncertain. Prices oscillate within a range as buyers and sellers battle for control. Breakouts. A dramatic moment in the story where price decisively moves beyond a range, often signaling a new chapter. Recognizing which phase the market is in lets you align your strategy accordingly. For example, trend following works well in trending markets, while range trading excels during sideways action. Point 3. Reading the dialogue. Price action is the market's language. Every bar on your chart is a sentence, every candlestick a word. Learning to read price action means paying attention to support and resistance levels, key plot points where the story often turns. Candlestick patterns, signals like pin, bars, engulfing candles, or dojis that hint at character emotions, like hesitation or conviction. Volume, the intensity behind the moves, showing how strong or weak the current trend is. By listening carefully to this dialogue, you gain insight into the balance of power between buyers and sellers. Point 4. Anticipating the next scene. Great trader is like a skilled reader who doesn't just consume the story but anticipates the plot twists. Using context clues, historical patterns, and current momentum, you form hypotheses about what might come next. For example, if price approaches a strong resistance level with declining volume, you might anticipate a reversal. If a breakout happens with heavy volume, you expect the trend to accelerate. If the market is stuck in a range but approaching the end of a consolidation period, you prepare for a big move. Anticipation helps you enter trades with confidence. An exit before disaster. Point 5. Keeping a trading narrative journal. To develop this storytelling skill, keep a journal focused on market narrative. Before entering a trade, write down what story the market is telling you. Note the characters, the current plot, the emotional tone. After the trade, reflect on how the story unfolded and how your interpretation matched reality. This practice sharpens your intuition and builds your ability to read between the lines. 6. The market is never boring when you know the story. When you begin to see the market as a story unfolding, it transforms your experience. Instead of randomness, you see drama. Instead of noise, you hear meaning. This perspective makes you more patient, more observant, and more in tune with the market's rhythm. You're no longer a bystander. You're a participant in a dynamic, unfolding narrative. Final thoughts. Mastering the market story. Understanding the market as a story puts you in the driver's seat. It teaches you to read subtle signals, understand human psychology, and anticipate future moves. The market is a complex tale, but every story has patterns and themes. Your job is to learn those patterns and use them to your advantage. Master this, and you'll trade not just with knowledge, but with insight. Chapter 10. Evolve or Die. The lifelong journey of mastery. Trading is not a static skill or a one-time achievement. It is a continuous journey, an evolving process that challenges you to grow, adapt, and master yourself, and the market's over. A lifetime. In this chapter, we explore why evolving is essential for long-term success and how to embrace mastery as a lifelong commitment. Why evolution is non-negotiable and trading the markets never stand still. They shift, adapt, and respond to countless factors, from geopolitical events and technological advancements to changing trader psychology and new regulations. What works today may not work tomorrow. Similarly, you as a trader cannot remain the same. If you don't evolve, if you cling to outdated methods or resist learning, you risk becoming obsolete. In the trading world, stagnation is equivalent to falling behind. The harsh truth is either you evolve or you die, figuratively. In terms of your trading career, the trader's growth mindset mastery begins with mindset. Successful traders adopt a growth mindset, the belief that abilities can be developed through dedication, learning, and effort. They see challenges as opportunities to improve, not as threats. When losses happen or strategies fail, they ask, "What can I learn?" instead of "Why me?" This mindset fuels resilience and curiosity, which are critical for evolution. Continuous learning. The trader's daily habit, the journey to mastery, demands continuous learning. Study new strategies and markets. Keep an eye on innovations and techniques that could complement your style. Learn from other traders. Join communities. Listen to experts. Read books and watch webinars. Review your trades. Analyze successes and failures to uncover patterns. Stay updated on global events. Because macroeconomic shifts influence market behavior, master traders treat learning as a daily habit, not an occasional activity. Adaptability. The ultimate trading weapon. Markets change, sometimes slowly, sometimes suddenly. To survive, you must be adaptable. This means adjusting your strategy to fit new conditions, letting go of methods that no longer work, being open to feedback and willing to pivot, managing risk differently as volatility fluctuates. Adaptability is what separates traders who thrive through bear markets, bull markets, and sideways action from those who falter. Embrace small, incremental improvements. Mastery is not about giant leaps. It's about small, consistent improvements. Focus on refining entries and exits, improving risk management, enhancing emotional discipline, sharpening market reading skills. These small upgrades compound over time, transforming you from a beginner into a seasoned professional. Overcoming plateaus and setbacks on the path to mastery. Plateaus and setbacks are inevitable. You might find yourself stuck, trading sideways with little progress. Or you might suffer a series of losses that shake your confidence. Remember, these moments are part of growth. The key is persistence. Use setbacks as feedback. Reassess, recalibrate, and keep moving forward. This resilience is the hallmark of true mastery. Developing a personal trading philosophy. As you evolve, you'll begin to develop your unique trading philosophy, a set of beliefs and rules that guide your decisions. This philosophy blends your risk tolerance, time horizon, preferred markets, and personal strengths. It becomes your trading compass, helping you stay grounded amid market chaos and emotional turbulence. The role of patience in mastery does not happen overnight. It requires patience with the market, with your process, and most importantly, with yourself. Celebrate small wins. Appreciate progress. Avoid rushing. Mastery is a marathon, not a sprint. Final thoughts. The journey is the reward in trading. Evolution is survival. Mastery is freedom. When you commit to lifelong learning and adaptation, trading becomes more than a way to make money. It becomes a path to personal growth, discipline, and self-awareness. Embrace the journey. Stay curious. Stay humble. Evolve continuously or risk falling behind. Because in trading, as in life, the only constant is change, and mastery belongs to those who move with it.